We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Dave Kranzler from investmentresearchdynamics.com. He's also the author of the Mining Stock Journal and Short Sellers Journal. How are you today, Dave?
I'm doing well, thanks. Thanks for having me back on.
Always great to have you and, chat about how you do a great job of really understanding things from a couple different perspectives. We were talking before we hit record this morning about, not only the metals, not only, let's say, Fed policy, but also how that affects a lot of the different facets of the market here. So I think an interesting place to start would be talking about how the accuracy of data and the reframing of the results of how companies are operating right now, how that can be misleading, especially as it comes to how companies are framing their guidance versus their actual profitability, as we see the lagging effects of the rate hikes taking effect in the real world. So how does that affect the home builders right now? And how are they kind of spinning the results to make it look a lot more positive than it might objectively look for them?
Sure. Reframing reframing the results is a good way to put it. Certainly socially correct. I probably have a less socially acceptable way of stating that, but the thing that is really struck me, because I primarily, for my newsletter, I do a lot of in-depth research on the construction sector and the home builders. Mm-hmm. And so I look at a lot of 10Qs and quarterly results in that sector and either listen to the earnings calls or read the earnings transcripts. And then same with the tech sector, especially the large, high-profile tech companies. And the common theme, especially for the last few quarters, because you're starting to see, like, if you look at like Amazon, or you look at any of the home builders, for the last several quarters, their growth rates have gone negative. Amazon they're still generating positive sales growth, but their e-commerce business, which they call their products business, includes Whole Foods, that actually generated something like, and this is off the top of my head, I think a $2 billion net loss in the fourth quarter. And it swung to a slight profit again in the first quarter. But the only thing, the cloud services business, AWS, is the only part of that company that's producing profitability. And the sales rate, Amazon gets a high stock multiple because AWS, they treat it like it's a tech company because of AWS. And, AWS had, 30% growth rate for quite some time on the top line. And it had very high margins. I want to say off the top of my head, 40% mm-hmm. operating margins. But over the last few quarters, that growth rate, I believe in first quarter, I think that growth rate had slowed down to 16%. And the margins had come down quite a bit. Again, off the top of my head, I want to say maybe mid-20s. And that's competition. It's a rapid slowdown in the amount of money that companies across America are spending, and, have to spend, or are willing to budget and spend on cloud services and computer equipment, and just kind of the general economic slowdown, and their forecast going forward for both business segments, the products business and the AWS, was bearish and negative. Mm-hmm. And yet stock price is now probably 17% higher than when it reported its quarter, about 3 weeks ago. So, and what happens is, and it's a similar dynamic with the home builders. And what happens is that, over the last 20 years, and it really got going during the tech bubble, is the earnings management game, and the guidance game. Mm-hmm. And it's become absurd now because it's so blatant. And what happens is is a couple weeks ahead of earnings. Management already knows pretty much what their numbers are going to look like. And so they get on the phone and call the analyst and say, hey, I think you're a bit too high on your estimate. And so the consensus estimates come way down. Management they take it to the extent where they sandbag it. So they guide the street to a number and Tesla personifies this, because they take a poll of all the analysts that cover it, like a few days before they report, and then they or like a week before they report, and they look at that, and then they call these analysts back and they guide them down more, so that they know they're gonna beat the number that is the consensus estimate. So anyway, you get the consensus estimate on these companies is walked down all quarter, and then they report, and it's reported as an earnings beat, even though operating income is down, expenses are higher, net income is down. In some cases, in most cases, earnings per share is down quarter over quarter, and it's also down sequentially quarter to quarter. In some cases, you'll see the EPS is actually higher, but that's because of the massive share buybacks. So you just look at the net income. You want to look at the economics of a company. Don't look at the EPS. That's the most manipulated number. As you go further down the income statement, the numbers get easier and easier to manipulate. It's harder to manipulate sales and gross margin, or that's the hardest to manipulate. It's doable, but Tesla's proof of that. But so what happens is the headline says XYZ company beats, and the algos pick up on that, and boom, they pile into the stock, and it drives it higher. Even though if you look at the numbers are terrible. And so that's how this whole earnings reporting process has become reframed. And it makes absolutely no sense. But, and then what happens is the algos jump in and push the stocks higher, and then retail jumps in and they buy call options, and then that causes the stock to move even higher. And that's how it works. Now, and then specific to home builders, as you mentioned, home builders peaked in late 2021. The stock prices peaked, the deliveries peaked, and this is across the industry, every single company. And some companies are outperforming others, and some companies have had double-digit declines, like high double-digit declines in their delivery rates. But the stocks now are trading higher or back to where they were at the end of 2021 when the entire sector rolled over. So that means their valuations are considerably higher than they were, despite the fact that the economics of the business continues to deteriorate. And you can't look at the quarter that was just reported or the last 12 months. Home builders, you look at new orders, and that tells you where the business is going. Every single home builder for the last, and again, it's at least the last 4 quarters, has been reporting year over year and sequential, and for the most part, sequential declines in new orders. And the other thing that's happened is because now that prices are coming down pretty quickly, whether it's the actual listed sales price or the net price, including home builder concessions. Home builders are offering huge concessions now to try and get you to sign a contract. The value of the order backlog, in some cases, for some of these home builders, is down 30-40%. And yet the stocks keep going higher despite that. And I think it's partially general optimism that lower rates are going to stimulate another housing boom. I don't see that happening, because if you look at the overall financial condition of most households that are below the 90 or 95% wealth and income threshold, right? So just call it not in the top 5% of wealth and income. Most of those households are pretty much at full debt capacity. Many of them they need credit cards to make ends meet on a monthly basis. In fact, I just saw, I think, can't think of the name of that, the most commonly quoted census company. Anyway, they put out, a monthly report, and it's something like 31% of all households now need credit card debt in order to make, monthly bill payments, make ends meet on a month. And that's not really making ends meet, right?
Mhm.
And that's why you're seeing household debt and especially credit card debt hit record highs every month now.
Mhm.
Or it's crazy. So, I mean, the whole system's been turned inside out, socially, politically, economically, financially. And you're really seeing that now in the stock market, because the stock market, what it's doing right now relative to what's happening in the system and what's going to happen going forward, it just makes no sense.
Mhm. Can we really, take the housing industry as a whole to understand how these secondary and tertiary effects of raising rates the way that we've seen them get raised, how that materially impacts a market as a whole?
Sure. I mean, when the Fed funds rate was basically targeted at zero, the range was 0 to 0.25%. A lot of, and not all of them, but then this is a generalization, but a large percentage of homes that were sold to the buyers were using the 3% minimum down payment from that Fannie and Freddie. I think the FHA is 3.5%, and those mortgages, people needed to use a low down payment mortgage in order to buy, in order to be able to afford the house, and the low interest rate made the monthly payment affordable. So what happened was, and this has basically been going on for the last 7 or 8 years, homes, someone makes the decision, not everyone, but your average home buyer makes the decision to buy a home and pull the trigger based on the monthly payment that they can afford.
Mhm.
And that's a monthly payment that is essentially, I think it was 2016 or 2017, the FHFA raised the debt to the debt to income limit from 40% to 60%. So that meant that with a mortgage, you could still qualify for a mortgage, even though 60% of your pre-tax income was being devoted to debt service of all varieties, right? Auto debt, credit card debt, personal debt, mortgage
Mhm.
debt. And so what happened is a large percentage of households really stretched in order to be able to afford a home. Okay. And then all of a sudden, inflation kicks in, interest rates go up, and you're still sitting on probably an all-in 4.5% mortgage. But all of a sudden now your household expenses have soared. I mean, even though the price of gasoline has come down a lot, it's still considerably higher than it was, say, 5 years ago.
Mhm.
So all of a sudden now, 5 or 6 years ago, you could make that monthly payment on your mortgage and pay your bills, and maybe with the help of a credit card, take a vacation, student loan, kid can go to college, blah, blah, blah. Now, all of a sudden, your electricity bill has gone up, in some cases doubled. Your gasoline bill has gone up. Your food costs have soared. Insurance has soared. Everything that you need or that you have to spend money on every month has gone up. Now, all of a sudden, you're stretching to afford your house, but you're not going to sell it because to try and maybe downsize. Because now all of a sudden, the $500,000 house that you could afford 5 years ago or 3 years ago, even now, all of a sudden, the equivalent $350,000 house with a 7% mortgage is unaffordable. So you're stuck, right? And that's where it is. And then with this low inventory narrative that you hear, there's not really low inventory. The number of homes per capita is about where it's been on average over the last 30 years.
Mhm.
But what has happened is corporate investors and mom and pop landlord investors, when interest rates were low, snapped up homes that they wanted to use to rent out, or they snapped up second homes. especially the corporations, the big corporations, were buying up 10,000 block home, tracts of homes, and they wanted to rent those out. So if you include the supply of homes that are vacant second homes or rental homes, there's not a housing shortage. And now a lot of these corporations are starting to dump their home portfolios because they don't make economic sense anymore. Rents are going down, but yet the cost of maintaining that rental property has gone up. So, in a lot of cases, you're finding yourself upside down between what your revenue generation is on the house and what your costs are to maintain the house. Mm-hmm. So, and this is all caused by Fed policy, right? They took down rates to zero. They completely loosened lending standards. The government, essentially your standard conventional mortgage issued to someone with a sub 740 FICO, that's basically what was considered subprime 15 years ago. So, but the standards have changed, and all of a sudden, that profile has transformed into, oh, this is a person who can qualify for a conventional mortgage with prime interest rate, prime credit interest rate attached to it. So the Fed takes interest rates down to zero, causes a massive housing bubble, stimulates a massive housing bubble, and then all of a sudden jacks rates up very quickly to 5%. And it's basically like pulling the rug out of the market, out from under the market. And we haven't seen the collapse yet, like we saw in 2008, 2009, but that's coming. Mm-hmm. And I don't think even if the Fed pauses or even starts cutting rates, that's not going to fix things, because that's not going to address inflation, and that it's not going to address the monthly costs that households face now, mm-hmm. with the same mortgage payment that they've had for the last 5 or 6 years.
Yeah, it's not like we're going to see these actual monthly costs, for example, cost of food, actually materially come back down to where they were.
That's right. I mean, there's it wasn't my idea, but to create this chart, but there's charts that have gone around showing the consumer price index, mm-hmm. right? And so you've gone, say, from, let's just say, a base level of 100 up to 120. Well, even if the inflation rate slows down, let's say it comes down to, maybe they get it back down to 2%, you're still not bringing the overall index back down, mm-hmm. right? You'd need massive price deflation for that to happen, and I don't see that happening.
Yeah,
I mean, the mandate of the Fed is to maintain a 2% inflation rate, right? Mm-hmm. So they're basically telling you we're not going to see price deflation. So your cost of living, which went from here to here, even if inflation even if the CPI goes to zero, it's still up here, right? And your real wages are declining.
I was going to say, I think that's one of the things that the Fed is probably scared most of, is that reverse wealth effect, right?
Man, I don't know who knows what the Fed is afraid of. I can't figure out what makes them tick, especially almost every single FOMC member. Their interpretation of economics is just mind-boggling, and reality.
Well, Dave, I was going to kind of, tie back together a couple of the points that we've talked about here by using the example that I saw on Twitter yesterday. And it was this story about a guy going in to buy a car, and he said he was going to pay cash. And they asked him if he would finance his purchase instead of paying cash. And the gist of what they needed him to do by financing it was to be able to bundle another, set of loans with his, because he had a good credit score, and he was able to let's say put, I think it was something like 80% of the loan as a down payment, just so that they could bundle it with other people that didn't have good credit and couldn't perform the same way on their loans, so that they could sell this package of loans together. I think that's something that makes it almost like this bizarro world of not being able to to really see the condition of the market by having, some good and some less favorable loans, which, I mean, is probably part of the process. But if you extrapolate that to different sectors, whether it's housing, whether it's auto loans, whether it's, let's say, credit card debt, anything like that, it really makes you wonder what the actual shape of the economy or the consumer, all of this demand looks like.
Well, not just that. I mean, it's modern financial engineering, right?
Mm-hmm.
And the reason why they have to do that is because the average financial condition of the underlying consumer supporting these debt structures is deteriorating. But if they, it's like the best explanation of this process is in the movie The Big Short.
Mm-hmm.
And it's gaming the rating agencies. It's basically exploitation of the financial system for the sake of earning, immediate huge fees. Like, so when they bundle these loans together, they sell them to whatever entity is going to, warehouse those loans and create bond trusts out of them. They mix in some good credit quality loans with some bad credit quality loans. That thing gets thrown into a financial blender and sliced up into a bond trust with various risk tranches. Mm-hmm. And the top tranches get a AAA rating. And then the tranches below that, say, let's call it the triple B tranche, gets the triple B. That's probably the worst tranche. That probably causes the most destruction because now all of a sudden you get companies and funds and pension funds that can invest in investment grade, and they invest in the triple B tranche. But if they, because it pays a much higher yield than the higher rated tranches. Mm-hmm. But if you go in and analyze the paper, the underlying each individual mortgage or debt agreement that's supporting that triple B tranche, there's no way that tranche should have a triple B rating. But the idea is, if you blend enough of them together, you're going to have some defaults, and this is what we think the default rate will be. So on average over time, this trust will fully pay out, and you're fine. Even but there's a reason why you're getting 200 basis points more on it than you are on the trusts above, right? Mm-hmm. And then what happens is
that's probably considering within a deviation of, let's say, 20%, that financial conditions stay the same. Like that's barring any catastrophic.
Exactly. They're these assumptions that they're making about the degree of financial stability that'll continue on going forward are mind-boggling. Mm-hmm. And they're unrealistic. And that's why these things blow up. I mean, we're seeing it's not the same labels put on the debt securities. Like back then you had the liar loans and things like that. And actually we're starting to get back to that. Mm-hmm. I know people who are in the, realtors or mortgage brokers or work for companies similar to Zillow. And they're like, you know what, it's all coming back again. The 228 adjustable rates where, you can take down a mortgage at a subsidized rate for 2 years. And then in 2 years, it resets up to the market rate. But the convincing argument from the realtor and the mortgage salesman is, yeah, but rates are going down, so you're probably going to be able to refi at a lower rate. And that's the assumption that you enter into an agreement, a 228 right. agreement. Mm-hmm. And that's how a considerable amount of home sales have been generated over the last 12 months. And it's scary. And then you start seeing these stories with these auto loans, like the ones that we saw, like the one yesterday posted on Twitter. I think that guy was in Canada, but the same thing's going on in the US for sure. Mm-hmm. And so it's the same thing where they're taking very risky debt securities or loan agreements, packaging them in with some investment grade or prime quality debt agreements, and blending them together, selling them to investors. And then once you've packaged that loan and sold it off, unless you're the servicer of that bond trust, you don't care what happens to the loans. You don't care if the majority of the underlying borrowers default. It's not your problem. You've already earned your fee on the loan. Mm-hmm.
Dave, do you think that the banking crisis that we've seen so far is really a result of the fastest rate hiking cycle that we've seen in history? Is this the duration mismatch that we heard so much about? Is that part of the consequence of the rate hike cycle that we've seen?
And that's the narrative that's being fed to everyone. And it certainly the Fed hiking rates as fast as it did, and banks not being able to, the money that they borrow from depositors, the banks not being able to re-lend that money out at a rate that's higher than the bank's cost of capital, unless they go into these longer duration securities. That was exacerbated by what the Fed did. But it's not like the deposit outflow started in March or February, like we were led to believe, or not led to believe. If you look at the facts, you can see what the truth is. I mean, the deposit outflow, and you can see it. And again, this is off of the top of my head, but the deposit outflow from these banks really started. It started kind of slowly in the summer of 2022, because all of a sudden, you've got, if you got a large sum of money sitting in a checking account or a savings account paying 0.5%, and all of a sudden you can go into 3-month T-bills and earn 2% or 3%, you're going to make that move. And that it was going on slowly, and then all of a sudden, suddenly, and it wasn't because some some private equity fund owner told his client companies to get their money out of Silicon Valley Bank. That's not what caused the demise of Silicon Valley Bank. So the Silicon Valley Bank's demise was coming anyway, because if you went in and looked at their loan portfolio, 30% of their loans were total garbage, total crap. I referred to it as, part of that 35% was garbage for raccoons to eat. And the other part of it was inedible fecal matter. And that's what it was, if you look at what it was. So Silicon Valley Bank was going to blow up anyway. And it's just as much. So the economy was already starting to contract before the Fed started raising interest rates. And you can see that in the numbers. You can see that in the numbers in the home builders, because their business started going south in late 2021. You can see it in retail sales, especially real retail sales. Don't look at the nominal number. Look at real retail sales. Look at the holiday sales in 2022. The economy started heading south, and it was going to affect, first and foremost, the companies that Silicon Valley Bank was lending to. And so they were going to have a hole blown in their balance sheet, regardless of what the Fed did with interest rates. So yeah, the Fed hiking rates as quickly as it did exacerbated it. And circling back to, if there's anything you wonder that the Fed is really terrified by, or what they're terrified most by, I think they're terrified most by, or if there is anything that terrifies them, it's the real rate of inflation. The real rate of inflation isn't the CPI rate of inflation. That's a BS number. And everyone knows it now. Well, everyone who looks into the facts, the guys drooling over CNBC and living on every word Kramer says, they don't look at the facts. But if you go in and look at the facts, the real rate of inflation is it's come down a lot. It was probably got as high as 16, 17%. And that's the work based on the work that John Williams does with his shadow government statistics. And his numbers now come down to about 12%. And I think that's probably more closely reflects the type of inflationary costs that the average household faces right now. It's not 5% or whatever, garbage number the latest CPI was. So I think the Fed was terrified of how quickly inflation shot up, real inflation, because they see the real numbers. They know what they are. And that's part of the reason why they jacked interest rates from 0 to 5% so quickly. They basically had to, even though that's not gonna solve the inflation problem. It'll help it, but it's not gonna fix it.
Well, what are some of those themes that are really pushing inflation higher here? And do you think that we get, we start to see even the official, as you say, the official BS number keep going up? It seems like there's only so much that the Fed can affect by trying to dampen demand on the back end versus what let's say the more approximate causes of the inflation that we're seeing are.
I mean, it's like Milton Friedman was famous for saying, although I bet you the phrase really came from his wife, Anna Schwartz, because she was the real brainchild in that relationship. But, inflation everywhere and always is a monetary phenomenon, meaning if you're going to print money and you're not going to be able to generate enough wealth output to justify the rate at which you're printing money, you're going to cause inflation, right? And really simplistically put, let's just say, in economics, you always have a one product economy. It produces widgets, and then you've got your money supply, right? So if you start creating money at a rate that's faster than the number of widgets that you produce, all of a sudden the system has a lot more monetary units that it can use to buy a lesser relative amount of widgets, right? Mm-hmm. And so by the law of supply and demand, the price goes up, and the price is reflected as price inflation. And that's about as simplistically as you can state it, and really uncover what the truth is about why inflation is a monetary phenomenon. And if you look at that chart, you can see that the money supply really, and this is just M2, and that's not even the real money supply. I mean, not only do we have a fake CPI rate, we got a fake GDP rate, we also have a fake money supply proxy here. The real money supply is what they were using to calculate M3, but the Fed knew this was coming, and that's why they decided to discontinue publishing M3. I know they know what it is behind the scenes. Mm-hmm. And we're the only major industrial company that does not produce the M3 statistic. And that's the more complete money supply statistic. But anyway, M2 is still not a bad proxy. You can see in the middle of 1995, it starts to increase. There's an inflection point, it starts to increase and then slowly start to go parabolic. And that was back then, that was Alan Greenspan. He used to goose the money supply to address all the financial crises that popped up. If you remember, we had the Drexel Burnham S&L crisis, we had the Asian currency crisis, we had the blow up of Russia. There was a series of emerging markets crisis back then, series of crises that he addressed by printing money. And then obviously in 2020, we know what happened. And you can see that there's been an almost Roman candle effect on the money supply, on M2 anyway. And if you look at, so supposedly the Fed has been engaged in this quantitative tightening operation. But if you look, you can see, maybe the money supply is down about 2% from what it was back in 1990. And that spike up that you see in 2020. Now, let me just head back here, because a lot of the increase in the money supply was not offset by domestic wealth output, mm-hmm. but it was offset by big corporations being able to lower their costs by offshoring. And that's one of the reasons they offshored, right? It got their costs way down. Mm-hmm. And so they didn't, because of the price inflation that otherwise would have been created by that increase in money supply, not offset by a corresponding increase in wealth output at the margin, because they were able to drastically reduce the cost side of their income statement, they didn't have to pass on the price increases that they would have been seeing if they were just producing in this country. So, but that game's over. And there's not a mechanism like that can basically absorb the increased costs that our entire system was facing. Mm-hmm. And so when they did what they did in 2020, it pushed it over the brink. And that's why all of a sudden, they couldn't even hide price inflation with the CPI. when the CPI went from, I think it was running around 2.5%, might have even been below 2% at some point in the last 10 years. I don't remember, but I mean, I think I remember seeing it below 2% a handful of times. But then all of a sudden you're up to, I think, what, 8% on one of the reports, something like that. So there hasn't been anything that they've been able to use to absorb the effect of that massive increase in money supply in such a short period of time. And that's why we're seeing the price inflation that we're seeing. Yeah, there was some supply chain BS tossed in there, and you did have the big spike up in energy. And I also think there's another spike up in energy coming at some point. But, so you do have some supply side factors, but I also think that the money printing and the increased the rapid increase on the cost side of the production equation, I think that's a big part of why you're seeing supply bottlenecks. I mean, we don't have supply bottlenecks anymore in the automobile market, durable goods markets, food, any of that stuff, right? The price of lumber's come down from 1,300 down to 400. Mm-hmm. So it's not like we're seeing supply constraints affecting the price side of the equation, and yet prices are still extraordinarily elevated versus what they were 2 years ago, 3 years ago. And they're not really coming down that much. I don't care what the official mainstream idiot narrative is. They're not. Price inflation, you've gotten the index, your price of what you're paying up to a certain level. And unless we see price deflation, which is against the Fed's mandate, right? Their mandate is 2% minimally, or ideally, which I don't know why. I don't know why I should be excited about paying 2% more next year for the same thing I paid for this year. That doesn't create economic value. It doesn't create real economic value. Mm-hmm. So I mean, inflation is here until they cut down that money supply drastically. But the problem is, if they do that, the system will completely collapse, because the system's completely predicated and based on that increase in money supply, which thereby supports the increase in credit, because it's credit that drives the entire economy, the entire system. It's credit that drives the entire financial system. And so if they pull back too hard and too quickly on the money supply, everything collapses. Mm-hmm. And I think we're going to see everything collapse anyway. It's just a matter of whether it happens, soon or eventually.
Well, Dave, as we're talking about M2 and the money supply, the next step obviously is the idea that the debt ceiling is up for debate again. Seems like a broken record talking about this every pretty much 2 years here, but do you think that there's anything different about this debt ceiling debate, or is it just kind of business as usual?
I think it's business as usual. I think that the volume around it is amplified, but everything in our system has become amplified and extraordinarily volatile and unpredictable. And both sides of the negotiating table know what happens if they don't. I wouldn't be surprised. I think we saw this when Trump was in office, where they suspended the debt ceiling until they could reach an agreement. I think that was during the Trump administration. I wouldn't be surprised to see something like that again. So they suspend the debt ceiling. Government the Treasury can go out and issue as much paper as it wants. Government can keep on spending money. It can keep on sending hundreds of billions over to Ukraine, from which the public here gets no benefit. And I think that's the only choice they have to prevent a systemic collapse now. Mm-hmm. Right. So if the Fed did the right thing and did what it should do, and it were to do what it should have done back in 2008, it's going to cause a systemic collapse. And if the government, if they play chicken and they default on the debt, it's going to cause a systemic collapse. And I'm certain there isn't anyone sitting at the negotiating table that wants that. So to me, this is just, amplified kabuki theater, and the various parties will extract their pound of flesh, and then they'll hug and kiss and make up and sign an agreement to raise the debt ceiling.
Mhm. So, does that debate also, is that bullish or bearish for the precious metals? Does that end up being, let's say, either way, or out of the ways that it can get resolved, does that end up being a good thing for the price of gold?
Oh, it's just fantastic for the price of gold. I mean, honestly, so I jumped into this sector, and I dove in with like 20-hour a day passion back in 2001. And right now, I am 100% certain that all of the fundamental factors that drive the price of gold, I'm not talking about on a day-to-day basis. I mean, obviously, in the last 2 weeks, the price of gold has come down $100 through today. But, all these variables that drive and fuel the price of gold are stronger now than they have been at any time, even in 2008, up till now. And one of the factors that is extraordinarily stronger is the amount of physical gold that is being scooped up and moved to the Eastern Hemisphere. I mean, China's been accumulating gold for a long time. Russia's been accumulating gold for a long time. India's been accumulating gold for a long time. Russia, we don't really know what they're doing. I mean, they say they've paused for now. Who knows? Mm-hmm. China, we know that they own a lot more gold and are buying a lot more gold on a monthly basis than they officially publish. India's, they're steady. They're a steady, 800 to 1,000 ton importer every year. They've been importing a lot of silver over the last year. And that's part of the reason why you've seen the price of silver go up quite a bit over the last, I don't know, call it 6 or 8 months. But the physical market, and those of us who used to talk about it all the time, 20 years ago, 15 years ago, we always knew that there would come a time when the physical market would start to push the prices up from below. And when I say below the enormous level of paper derivatives that are used to help try and contain the price rise in gold and silver. We knew that eventually the physical demand was going to cause that to happen. And I think we've been starting to see that happen probably, I don't know, last 3 or 4 years. I mean, in 2020, I believe gold almost went below 1,300. And just recently, we were almost back at 2,100. Mm-hmm. So despite the intra-week and intra-month interventions that you see and paper, gold, and silver market trading dynamics that cause high volatility in the price of gold and silver, you're still on a pretty significant upward trajectory. And I think that the current price correction, as well as, the cauldron of all the things brewing, like the debt ceiling, how can it possibly not be bullish for gold that all of a sudden the U.S. government's not going to cut its spending budget and it's going to raise the amount of debt by several trillion that it's allowed to issue? How in the hell can that not be bullish for gold? How in the hell, what's going on geopolitically, not just in Ukraine, but all over the world? I mean, there's animosities bubbling up again in the South China Seas. We're not necessarily hearing about it because the New York Times and the Washington Post and national network broadcast news, they only report what they want you to hear. You don't hear all the news. You got to go to alternative media. So how can all this stuff not be positive for gold? Oh, and then at some point, we do know that the Fed will have to pivot unless it wants to let the system collapse. And by pivot, I mean start taking rates back down and printing more money. So we saw they printed 400 billion, 3 or 4 weeks ago to stabilize the banking system. So they're not done printing, and that's just a hint of what's coming at some point.
Mhm. I think another one of those pieces of the puzzle that we didn't touch on here is how gold has been bought, as or from the Eastern central banks, as you did mention. But what do you think the next steps are for that gold to become part of any type of monetary system?
I think it's happening now.
Mhm.
I think it's happening now. It's not going to happen all at once, right? Because I mean, and I figured this out 20 years ago, because I remember back then everyone used to say, including me, why doesn't China just go in and buy up all the gold and silver on the COMEX? It would be, you know, it would be a penny in the PBOC bank in terms of cost for them to do that, right? So, but if you think about it, they don't want the dollar to collapse right away. They don't want, I don't know if they really want the dollar ever to collapse, because look at, that would be like shooting themselves in the foot. I mean, they still own what, 1.1 trillion worth of treasuries.
Mhm.
So if the dollar collapses, that's a 1.1 trillion dollar loss that they take. And they don't want that. I mean, they've been slowly divesting themselves of treasuries, and they've been using a lot of that capital to buy gold, buy silver, buy hard commodities. I mean, they were the ones, for the most part, that drove up the price of copper. You can see it on the chart. They did it, I think it was like in 2006. Again, this is from memory. I haven't looked at the charts recently. But like say 2006 to 2008, you had a bounce in the price of copper. That was Chinese buying. And a considerable amount of the price rise that we saw over the last few years, I mean, yeah, there's supply and demand dynamics, but part of that is being driven by the enormous amount of base commodities that China's been buying. But at any rate, I mean, it just it appears as if the Eastern Hemisphere bloc of countries, and also several South American countries, right? The BRICS, but there's other countries that are starting to jump on board. It appears that they're working on some type of alternative monetary system. And I don't know, I've read analyses that suggest it's something that might be rolled out this year, but we are starting to see all of these countries start to not use the dollar in their bilateral trade, right? I mean, the most high profile one is Xi Jinping going over to Saudi Arabia and meeting with MBS. MBS refused to meet with Biden when Biden went over there. It was a total embarrassment for this country. And shortly after that meeting, Saudi Arabia announced that it was looking into doing oil trades with Russia that would settle in yuan. Mm-hmm. And I know for a fact that the United Arab Emirates is settling their oil trades with several countries like India in their currency, the dirham. And that's what's happening. We've seen South American countries, I can't think of the specific ones off the top of my head. I know Brazil announced it, and there's been a couple others that have recently announced it that said they're going to start using their currency with the counterparty country's currency when they do bilateral trade, right? And so that basically takes the dollar out of the equation. Mm-hmm. And it's coming, and again, it's one of these slowly then suddenly phenomenons, and it's been happening slowly for many years. It's started to speed up, and the U.S. actions with respect to sanctioning Russia and freezing their assets that were held outside of or in Western central banks, that basically triggered an acceleration of this process to kind of de-dollarize the world. Mm-hmm. And again, I'm not saying that, or I'm even advocating that the dollar is going to go away. It's just not going to be the reserve currency, and that's going to cause a massive economic blow to this country. Mm-hmm. Because that's a big part, if not, that in the military or what's been the basis for the U.S. to maintain its lifestyle and its wealth over the last 50 years.
Dave, I've had a couple of conversations recently around, let's say, the confidence or maybe lack thereof in the miners. They seem to be underperforming the price of the underlying metal. As you mentioned, we were right near the all-time high recently, within $100 of the all-time high. So what do you think is your assessment of why the equities, the gold mining equities, aren't performing to the level that one would think they would, with gold being, right near the all-time highs?
Sure. Part of that, I think, is just stock selection from people who are complaining about it, and without question. And you can see it in longer term charts since let's call it 2011. I think I looked at a chart recently, but for sure for the last 5 or 6 years, and just use GDX as the proxy. GDX has underperformed gold and I believe silver. I saw a chart recently, and I've done these charts myself, but don't update them all the time. But I saw a chart recently, and it showed the price of gold compared to GDX, and the mining stocks have definitely been underperforming the price of gold. Part of that, I think people are, retail investors, who are a large portion of the investors in the junior project development mining stocks. A lot of them got burned and have been burned over the last 20 years. And so I think there's a little bit of reluctance in that investor segment. Another aspect of it is in the run up from 2001 to 2011. And my thesis here is that we're in a secular gold and silver bull market that's punctuated by some bear and bull cycles. And so we had a bull cycle from 2001 to 2011, and we had a 4.5-year bear. And now we're, in the middle of another bull cycle, because certainly price of gold and silver, and I think, and the Amex Gold Bug Index and GDX are above where they were at the end of 2015 or 26 at the end of 2015 when this bull cycle started. So if you just say, okay, we're in the middle of a bull cycle, and maybe we're halfway through, maybe a little more than halfway through, but we still have, say 4 to 7 more years to go, we're going to start to see the best price increases for gold and silver in the mining stocks, say over the next 3 or 4 years. But the reason why I bring that up is back in the last cycle from 2001 to 2011, after 2008, you started to see large general mutual funds pile into the mining stocks. Fidelity had a couple generalist funds that became huge buyers of mining stocks, as did several other, big money management companies. And we haven't seen that yet. You're seeing, you might be seeing some of these fund complexes buy some GLD and SLV. Oh, we own gold, we own silver, we have GLD and SLV. And that, and that's helping, but they're not piling into the mining stocks yet. So we haven't seen that aspect of it yet. However, to debunk this idea that the mining stocks have been terrible lately, and I just ran these charts yesterday because I wrote about it in my mining stock journal that gets released this afternoon. And I discussed it in another podcast, but GDX between the end of September 2022 and the beginning of April rose 62%. Now that probably shocks people because they say, oh, well, I'm in, XYZ stock and that hasn't moved. Well, you're right, because you're probably in the junior, as I am, you're overweighted in the junior development microcap stocks, under 500 million, for sure under 100 million market cap. And those stocks haven't really moved. Some of them have, some of them have, like I'm a big owner of Viva Gold. And it's one of my strongest recommendations in my newsletter. And Viva Gold has gone up over 60% in the last, 5 or 6 months. Mm-hmm. So there are some stocks that have moved. And so if you feel like you haven't been participating in any of this, you got to look at your stock selection. Mm-hmm. Okay. Gold was up in the same period. Gold, again, well, these numbers are off the top of my head. Gold was up, I think, 24%. Silver was up like 35%. GDX is up 62% over that time period. Mm-hmm. That's a phenomenal rate of return over a 6-month time period. If the S&P went up 62% in 6 months, they'd be doing naked cartwheels on CNBC and Bloomberg TV, right?
That's. They
wouldn't be able to contain themselves. They'd be so so jubilant, but you're not seeing that written about the mining stock sector, about GDX or about the precious metal sector. You're not seeing these eye-popping returns that have been generally occurred in the sector over the last 6 months. So, are we back to where we were at the top in 2011 in terms of the mining stocks? We're not even close. But I do think that we have that ahead of us.
Yeah, I think it's important to have that perspective that you just mentioned, to be able to understand that this is a process. It's not just going to happen overnight.
Right.
And that
these aren't tech stocks. It's
a
small audience of investors. It gets no airtime from the mainstream media. Actually all these junior microcap stocks, they don't have options that you can trade on. They are options. When you take Viva Gold, I started accumulating the position I have now at 8 cents. Mm-hmm. An 8-cent equity on a company that prospectively is going to be worth $100 million down the road. It was under $10 million market cap when I started buying the stock. I personally think it's going to be worth $100 million when it gets taken over in the next two years. Okay, that's an out of the money option that doesn't expire. So why wouldn't you be loading up on these things? You're not going to. Most of them are probably going to fail, mm-hmm. But the ones that work out you're going to have extraordinary returns on.
Yeah, balancing the big winners with some of the other ones that you granted are going to take a loss.
Right. That's what Eric Sprott's doing. Only he's not necessarily doing it with the $10 million market cap companies. He's taking his wad of wealth and he's spreading it around 100 different companies. And he knows 80% of those, at least 50% of them are going to fail. Mm-hmm. Maybe up to 80%. When I first got into this, the rule of thumb was the probability of taking a project from greenfield to mine was like 1%. Mm-hmm. And I think it's higher now because of the technology and because there's a lot more, I don't know, it just feels like there's a lot companies are able to crawl around properties a lot more electronic, with technology and on the ground. And so I think in that way, they've somewhat reduced their risk of success. But, Sprott knows that, let's say 50% of what he invests in fails and and then the next 40% does okay. He knows that 10% of what he's investing in are going to be grand slam home runs. And that'll way more than offset the money he loses on the losses.
Yeah, I think maybe another point to get your thoughts on is the idea that we haven't seen that the point in the market where that rising tide has lifted, let's say, most boats, not all boats, obviously, because we're just talking about how many are going to fail. But we haven't seen that tide come in that lifts even these companies that are maybe comparable to some of these tech names that are terrible companies. Even them get bought up.
Oh yeah, no question. There will be companies that don't deserve to go from 10 cents to $1 that go from 10 cents to $1. Mm-hmm. But when the mania, when the euphoria dies out, and the tide goes out, those companies will go back to 10 cents or lower. But there are plenty of companies that are trading at 10 cents that'll go to $1, and then they're going to get acquired.
Yeah.
So, we will see a dynamic like we saw with the tech companies, where you're going to see, some of these tech companies went from IPO at $20 up to $300, and now they're below $20. And we'll see that with a lot of the junior microcaps, but a lot of them are legitimate companies with projects that are going to work out, and they'll throw off great returns if especially if you start accumulating them now, mm-hmm. because you want to get in ahead of when that herd comes. And that's another reason why I think we're still in the middle of an extended bull cycle that has its most powerful leg to come. And that's because, well, first of all, gold has been outperforming silver this entire run that we've had, right? Silver has started to outperform gold, but the gold silver ratios, has recently been as high as 90. And at the top in 2011, it was down to like 30. So we haven't seen the gold silver ratio really come down dramatically. I mean, people start to get excited when they see it go under 80 briefly, and then it pops back up. But, I'll get excited when I start to see it go down to 50 or 6, go down to 60, because then I'll be like probably going to 50 and then 40, and that'll be part of this last powerful leg up higher that we have. But also the junior microcaps have not participated in this move that we've seen over the last 6 months. And really since August 2020, the junior microcaps have just been horrible investments. And I know because I've been holding them. So, but I leave cash so that I can add on when I'm ready to add on. And I think we're going to finally start to move higher. But at any rate, at some point, if this cycle is similar to the cycle that we saw in the first decade of this century, then we have ahead of us, we'll see in general the junior microcaps throw off 3 to 5x returns, and 10x returns won't be uncommon. And that's when you'll know, this is starting to get into the euphoria stage. And that, at that point is probably when you don't want to get too greedy, and start taking profits.
Yeah. Yeah. Once you maybe get to that area where you feel like a genius, and
and you can do no wrong, and it's going to go up forever.
Exactly. Yeah. Well, Dave, I think that's a pretty good place to kind of put a pin in it for today. Is there anything else that you think is worth mentioning before we do?
Put a pin in it. That sounds so existential.
A temporary pin.
I mean, if I had to add anything, it's just like, do whatever you can to ignore what you hear in the mainstream media. Because what you hear in the mainstream media is especially now, Orwell predicted this. What you hear in the mainstream media is 180 degrees from the truth, what's really going on, and like don't rely.
Like you have pinned to the top of your Twitter, right?
Right, exactly. And don't rely exclusively on other people to make your decisions for you. Do some of your own research. It's okay to use other people as guides, people that you trust or that you think, are in the ball game, but verify it for yourself, because I think that's where people get burned the most, is they put, it starts with putting trust in what you hear on CNBC, and then you get burned on that. And then you go on to Twitter, or you go into chat rooms and you put trust into that. Do your own due diligence. Get your ideas from other people, take what you like from their work, but do your own due diligence. And that's how I think you're going to have the best shot at surviving what's coming at us.
Well, I appreciate you giving us some great perspective on all these topics here today, Dave. Of course, for those that want to know more about you and your writing and your journals, that's available at investmentresearchdynamics.com and INVRES Dynamics on Twitter as well. Anywhere else you'd like to point to, Dave?
No, that sums it up pretty well.
Perfect. Thanks so much for your time today, Dave. Really enjoyed the conversation.
Thank you, Tom. It's great chatting again.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.